Welcome to the Explainer. Right now, the crypto market is literally holding its breath. Bitcoin is hovering in this incredibly high-stakes decision zone, locked in a brutal tug-of-war right around the $80,000 mark. It is an active battlefield out there. Depending on what happens next, we could see an explosive breakout to new all-time highs or a really sharp punishing correction. But we aren't just here to stare at charts today. Our goal for this Explainer is twofold. First, we're going to map out the exact technical structures governing Bitcoin's next move. And second, we'll equip you with calculated, mathematically defined risk trading strategies so you can navigate this crazy volatility without blowing up your portfolio.
Here's how we're going to break it all down today. First, we'll look at Bitcoin's current decision zone. Then, map out the scenarios for a bullish breakout and a bearish correction. Halfway through, we'll pivot strategies, looking at the very real danger of naked trades, and finally, how to master defined risk mechanics.
Let's kick things off with Section 1, Bitcoin's high-stakes decision zone and navigating the repair phase. Okay, let's dive into this.
So, to figure out where Bitcoin might be headed, we first have to really understand the phase it's currently in. Right now, the market is in what analysts are calling a repair phase, and this entire phase is anchored to one critical, psychological, and structural number, 80,000. Bitcoin has shifted from all that prior downside damage into a battle to reclaim value. Buyers are aggressively defending that 80,000 to 81,300 accepted value zone. And what's really fascinating here is that sellers have recently generated some pullbacks, sure, but they've completely failed to restore downside control. That 80,000 level is the active battlefield where buyers are successfully patching up the recent structural damage.
To measure this repair objectively, analysts look at something called regression channel mechanics. Basically, it's a mathematical best fit line used to define the current fair value path. Right now, Bitcoin is aggressively hugging the upper boundary of its regression channel. But more importantly, it has successfully flipped a multi-month red resistance line into solid support. By using that old resistance as a springboard, Bitcoin is signaling that the path of least resistance has actually shifted from down to up. We're seeing volume contraction right at the top of this range, and that often precedes a pretty violent short squeeze.
But hey, technicals don't just exist in a vacuum, right? They constantly interact with real-world catalysts, and we have a major regulatory event right on the horizon. On May 14, 2026, the U.S. Senate Banking Committee is scheduled to review the Clarity Act, which is a bill designed to clearly define crypto asset regulations. Markets absolutely hate uncertainty, but they love front-running news. So this date could act as the exact fundamental catalyst needed to trigger the explosive directional breakout or breakdown that the technical charts are priming us for.
Moving on to Section 2, Scenario 1, the bullish breakout, focusing on expansion and upside targets. So what exactly needs to happen for this 80K defense to push into a full-on market takeover?
Well, first, we need a reality check on where we actually stand. The current sentiment score is sitting at a +3 on a scale of -10 to +10. So the crucial takeaway here is that we are only in a mildly bullish repair phase. It is not aggressively bullish just yet. Buyers are improving their control near key support, but the bulls critically need to prove they can actually find acceptance at higher resistance levels. Just testing a level isn't enough. The market needs to actually accept and trade heavily at those higher prices to confirm a real breakout.
And here are the exact levels they have to conquer. The immediate gate is that 82,500 to 82,800 resistance zone. A daily close above 82,800? That is the golden ticket. If that gate is breached and accepted, it forces short sellers to cover, which violently squeezes the price upward. From there, the first major target becomes 84,000, which builds immense confidence and starts pulling in everyone sitting on the sidelines. If the volume really pours in after that, we are looking at a strong bullish continuation, pushing all the way up into the 90,000 to 92,000 territory.
However, we must remain completely objective. Section 3, Scenario 2, the bearish correction and losing the reclaimed support. Because what happens if this whole repair phase just completely unravels?
Well, the downside levels are just as clearly defined. The absolute first major warning siren is a loss of the 79,000 to 79,500 level. If accepted value falls back below 79,000, the market is loudly signaling that the recent repair has failed. Re-entering the 76,000 to 78,000 zone means sellers are regaining their efficiency. And if things truly turn sour, maybe triggered by a stall in that Clarity Act review, a drop below the vital 70,000 to 72,000 support could initiate a deep, painful correction all the way down to the 66,000 range. That would be a major structural breakdown.
Which brings us to really the most important question of this entire explainer.
With Bitcoin coiled up like a spring and a massive breakout or breakdown staring us right in the face, how do we actually trade this without risking a catastrophic loss? Getting the direction right is only half the battle. Execution is literally everything.
That takes us straight into Section 4, the danger of naked trades and uncapped risk in volatile markets.
Look, the most common way retail traders express a market opinion is by just buying or selling naked options. It's that classic crypto degen mindset of swinging for the fences. But let's look at the harsh reality here. Buying a naked call relies on you perfectly timing the breakout. If Bitcoin just stays flat and chops around 80K, the rapid time decay of the option will just bleed your premium completely dry, resulting in a 100% loss of the capital you put into that trade. On the flip side, selling a naked put to collect premium exposes you to massive, potentially catastrophic downside if the market suddenly crashes. It's totally uncontrolled risk, which leads to highly inconsistent long-term results.
So, what's the actual solution? Section 5, Mastering Defined Risk Strategies, Choosing Structure over Speculation.
And this brilliantly illustrates exactly how to fix that risk problem. You can systematically convert any directional bias into a specifically structured, capped risk trade. If you're moderately bullish on Bitcoin and expect some fast upside, you use a bull call spread. If you're bearish, a bear put spread. Even if you think Bitcoin is just going to bounce sideways between 79K and 82K, you can deploy a bull put or bear call spread to capture time decay safely. Every single market view you could possibly have has a specific risk-capped mathematical structure. Let's actually walk through a concrete numerical example of a bull call spread to see exactly how this works under the hood. Say we have a standard index priced at 23,000 for our math. Instead of just throwing money at a regular call option, you do two things simultaneously. First, you buy the 23,000 call for a premium of 100. But to help finance that purchase, you immediately sell a higher strike call, the 23,300 call, and you collect a premium of 60 for doing that. So you take the 100 you paid, subtract the 60 you collected, and your net premium paid is only 40. You have drastically reduced the upfront cost of entering the trade. Now let's look at why this is so powerful by comparing the two side by side. On the left, the naked call buy costs you 100, so your absolute max loss is $100. Plus, your break-even is pretty high. The market has to reach 23,100 just for you to make a single dollar. But on the right, look at the bull call spread. Because you offset the cost, your absolute maximum loss is capped at just 40. Your maximum profit is the width of the spread, which is 300 points, minus your 40 cost, giving you a max profit of 260. And crucially, your break-even drops way down to 23,040. You've made it so much easier for the trade to actually become profitable.
The capital efficiency here is just undeniable. With the naked call, you are risking 100. But with the spread, you are risking a strictly defined 40 to potentially make 260. It fundamentally transforms your risk-to-reward ratio. You can actually sleep better at night, because even in a worst-case scenario market crash, the absolute most you can lose on this position is mathematically locked at exactly 40.
So what is your actionable playbook going forward? It basically boils down to a simple three-step process. Step 1, form a clear hypothesis, using the technical analysis we discussed today. Know your direction, your magnitude, and your time frame. Step 2, always choose a structured spread over dangerous naked exposure. And step 3, calculate your exact maximum loss, maximum profit, and break-even point before you ever click the buy button. I think this quote absolutely nails our whole philosophy for today. The real challenge is converting that view into a trade where risk is controlled and outcomes are structured. Look, anybody can glance at a chart and guess a direction. Getting the direction right is entirely secondary to how you actually manage the capital deployed on that guess. Discipline and structure are what ultimately separate the professionals from the gamblers. Which leaves us with one final, pretty important thought. As Bitcoin aggressively hugs its regression channel and attacks that 82.8K breakout gate, the volatility is only going to increase. The technicals are drawn. The regulatory catalysts are officially on the calendar. When the big move finally happens, are you going to gamble your capital on a naked, uncontrolled prediction, or will you execute a calculated, defined risk strategy? The choice and the risk is entirely yours. Thanks for joining me on this explainer and trade smart.